Yeah, thanks again, Jim. So good morning, everybody. Huge thanks to the ETP Forum for giving me the invitation to speak, and I'm honored to be giving the keynote. I do a decent amount of public speaking, but a keynote is something a little bit different, so you have to dig a little bit deeper, and rarely will you ever see me read my notes, but I'll have to do a little bit of reading here to keep my thoughts on track. But that said, nobody has heard any of this content except me. I mean, given the demands on my time, job, kids, I had absolutely zero time to try any of this material out. So it's kind of like filming a Netflix special without the opportunity of, kind of working it out in advance, like at a Comedy Cellar in the West Village before you have it right. And then I thought maybe it would draw on like an old wedding toast or something that I could think about, but I bombed one for a very close friend in my early 20s, so it was not a good model to use either. So anyway, for one morning only, I give you the keynote, and my theme this morning is going to be about change. So there's lots of talk about change, and change management, change your portfolio, change your diet, and lots of talk about how ETFs and this structure has been changing the industry and driving change for investors. So to use ETFs, for income, to hedge, to change your asset allocation, how to reserve an ETF ticker that kind of sounds like change. Actually, fun fact, there are 24 ETFs with the word disruption or some kind of change theme in them. Actually, probably 25 if we check the filings at any point soon. But look, I've been doing this for more than 25 years, as sort of Jim alluded to, so I've been outed and been a big part of this change over my career. And I'd like to share a little bit of perspective and shed some light where I think this all might be going. And so I'll try to touch on a couple things, really how ETFs changed my career, how I think they're changing the industry, how asset managers, and many of you in this room, need to change to compete in the ETF market, and a little bit about how ETFs are changing the culture at BNY Mellon, the bank where I work. And if I don't ramble too long or get the hook, I'll share a few thoughts on where I think this is all going in the next couple years. So, as it was kind of alluded to in my background, I started my career as a management consultant. I don't want to name check the firm because it will definitely make me feel old because it's not, that brand isn't around anymore, but stumbled into ETFs to work with Barclays Global Investors, BGI, on the project to create what became iShares. And the product guy in me quickly realized how big the opportunity was. Wasn't sure how big, but it was clear to me that even moving the market share dial a few points would be meaningful and honestly keep me employed for a while. But what really stuck with me was the microculture around ETFs, even back in the late 90s. While the number of industry professionals working in ETFs has grown substantially, a lot more people in this room every single year, the core ETF culture largely remains intact, even after we've kind of gone mainstream. There's always been this us against them, good versus evil, nerds against the cool kids, quants versus the rest of the portfolio management team, cheap versus expensive, stick it to the establishment, democratize investing. This DNA runs deep in this industry, and I've always felt the ETF crowd was sort of an odd band of zealots of sorts. Honestly, a great group, and has a different vibe than any other space in the industry. I'll touch on this a little bit more later, as I think new entrants need to adopt at least a little bit of this DNA to be able to compete. But from a career standpoint, it was a little about luck, a little about recognizing an opportunity, a little about clicking with this group of like-minded people, and honestly, timing is everything, of course. So I was fortunate enough to be on the ground floor of helping to build both ProShares and then later on WisdomTree, two leading ETF firms with different products but similar forces of change in the industry. Leverage and short, smart beta, other products. So yada yada. I wind up at the Bank of New York about 3.5 years ago to look after the ETF business. And this represented a completely different kind of professional challenge for me. And I like to make the joke and say I used to mine for gold and now I sell picks and shovels to the industry. And since I used to be a practitioner for many years, I offer help to clients all the time on which tools to buy, how not to cut off your arm with one of the tools or strain your back with the pick and shovel whenever you want to use it. But the perspective and the scale is vast. So BNY provides the infrastructure for more than $1.6 trillion of ETF assets globally. We processed more than 1.8 trillion in notional order volume last year and originated and settled over 10 million trades. We provide other services, FX, securities lending, et cetera, for more than 1,500 ETFs. We offer sub-advisory services to the industry and the like. But there isn't a single ETF product that we don't service right now. So you get the idea. I'll end my plug. But in this role, I've been fortunate enough to start on the ground floor, and now I have a bird's eye view, really for the last 3.5 years, across a wide range of clients, products, industry professionals, and organizations really around the world. And so talk a little bit about how this is changing the industry, at least what I see from my perspective. So I've talked to many of you, I know many of you in this room, and I often describe my ETF politics as a structural libertarian. If you can wrap it in an ETF structure, why not make it low cost, transparent, tax efficient, available on a lit exchange? I will not do this from the stage, but I'll be happy to debate anyone on the various product villains afterwards. But after all, I'm the guy who can claim a little bit of credit for putting the leverage and short ETFs into the market, which were once dubbed the financial weapons of mass destruction, as we all know. So in short, you can use a hammer to build a house, or you can hit someone over the head. Generally, I feel this way about most ETFs. But really, ETFs, again, and again, it was alluded to in the opening remarks, have really torpedoed a hole right through the middle of the asset management ship. We all know that ETFs are killing mutual funds. And over the last 20 years, to give a little bit of broader perspective, nearly 2.2 trillion has flowed out of equity and fixed income mutual funds. At the same time, 4.3 trillion has flowed into equity and fixed income ETFs. That's a $6.5 trillion swing for those who are doing the counting. Last year, it was around $1.6 trillion swing in terms of outflows to inflows. So not a bad place to start when you're talking about industry change. And the bull market subsidy is over, right? So this year, it's been about a 700 trillion swing so far, give or take. But what's interesting is this massive cash pile with around $1 trillion going into money market funds this year is quietly building in the background. But when that cash comes back into the market, to me, the only question is when and how much are going to go to ETFs. No way these assets are going back to mutual funds 100%, not even close. So for now, asset managers are enjoying some of that flow into the money markets at higher fees because money markets, for different reasons, have not gone through the kind of price compression that we've seen or the reckoning on price that we've seen in other structures like ETFs and other asset types. So not here to bury or eulogize mutual funds, but it's just worth pointing out how quickly and how big the industry is changing from a quantitative standpoint. But it's not just ETFs. The retirement assets are leaking to CITs. They've been doing so for a while. SMAs continue to steal market share from mutual funds, but honestly, they're an increasing threat to ETFs. But then you have CITs and SMAs that hold ETFs, now target date ETFs. So there's opportunities all around for asset managers that expand beyond ETFs and even to use ETFs inside those products. So I think ETFs really are a catalyst for many of the trends that we're seeing in the industry. They didn't necessarily start it, and in my view, they're highly unlikely to finish it. But it's just that, ETFs line up with the zeitgeist really of what's going on right now, and they line up very well. So, sucking the cost out of the industry is a good example. You could argue they have been a catalyst or the catalyst. I see them more as a facilitator for that trend. ETFs have been a driver, behind the shift to fee-based advisory. We all know the story here, but would this have happened without ETFs? Maybe. Have ETFs been a driver towards passive investing? Absolutely. They didn't start it, but gave it some rocket fuel. And I think, again, as it was alluded to in the opening remarks, clearly ETFs have captured the imagination and the dollars of the younger demographic. There was that survey, and there have been others about millennials, which have more of their portfolios in ETFs today than Gen X and boomers, and anticipate a steady rate of growth over the next 5 to 10 years. Again, the transfer of wealth from those boomers and older generations was going to happen either way, but ETFs appear to be the major beneficiary of that transfer of wealth. And the numbers on actively managed ETFs sort of mark another phase in this disruption. I'll just look at some recent examples, right? So 57 ETFs launched in October here in the market. 96% of those ETFs were active. 73% of the total were active this year. And the flow rate has picked up. It actually was a little higher. It's come back down. It's now around 21% of the flow into those actively managed ETFs. Now that flow is concentrated in low-cost or solution-oriented types of strategies, and the stock picking remains challenged across the board, including ETFs. But no doubt, it has clearly inspired a wave of product development and market entrance. We're seeing this every single day in our own business, and some of these active products are riffs or clones off existing mutual funds, but some are also quite innovative, like what we're seeing with the use of options inside ETFs. What's working are these package portfolios and package trades. It's easier to have an ETF take care of your covered call Tesla strategy or box spread than just roll it yourself, and all of that's generally done with low cost. But all of that is putting serious pressure on the industry to keep up. Asset servicers like ourselves, market makers, distribution platforms, portfolio managers all need to evolve their business, change their operating models to enhance their technology to scale alongside the industry. But product development is running faster than the market is also able to digest it at times, and the fee pressure on all of us remains relentless, and in my view, is getting close to the limits in the short term of where things can sustainably go. So how do asset managers need to change? In my seat, I'm constantly surprised at the lack of understanding that clients and industry professionals have around ETFs. I mean, it's 2023. I mean, last month, 1/3 of the total trading volume were ETFs on the market. And when I talk to clients and come across these people, typically they fall into one of three camps. Either the rookies, who generally want to figure this out. Two, I think you sometimes come across the intellectually curious who want to find it all fascinating but only wish to dabble. And then there's three, there's the naysayers, right, who sometimes come across with a range of ETF conspiracy theories, many of which we've all heard, blaming ETFs for market structure and other ills, and come across all three multiple times a week. It happens all the time. So I'll step back and tell you a quick story, and I think it will kind of illustrate and sort of bring some of this home. So, and it's kind of funny. So back when I was at WisdomTree, we were in a race to launch the first physical India ETF to market back in 2008. It's ancient times in the ETF market. So INP, which was the first and well-established exchange-traded India product, was in the market, but this product was an exchange-traded note or an ETN, which is a debt instrument not structured as a traditional ETF. And we saw an opportunity, but so did PowerShares, dating myself once again, because it's now a dead brand, folded under Invesco. We were in a race to be first, and it was a complicated launch, and we needed to set up an SPV first in Mauritius for tax reasons. It doesn't exist anymore. Typically, they go direct to India, but at the time, Mauritius was the way to go. I actually had to go to Mauritius for a board meeting, and I stayed at this fancy resort, and that's the only thing on the island, and it was weird. I was the only sort of creepy solo guy sitting on a beach chair by myself with all the honeymooners walking up and down the beach. And I actually went, after that, I went water skiing in the Indian Ocean, which I thought was really cool the morning I was supposed to take off, and I thought I broke every single bone in my body and packed my Advil and my checked luggage, which was a huge mistake. Anyway, I digress. So it was tough to get approval from the Indian regulators at the time, and we were hearing gossip that PowerShares at the time was sort of nipping at our heels to get to market first. And as you know, first to market, not always, but often is everything, especially when you're talking about an access product. It came down to the last item, which was obtaining a PAN number. And the best way to describe what a PAN number is, it's sort of like getting a tax ID or a social security number in India. It was taking several days, and I figured out that we could get it in person. So I called our accounting firm who had an office in Mumbai, and they ended up sending a young analyst down to the local tax office. It kind of sounded like a DMV. And he waited 8+ hours, but he got it in person. We launched 72 hours later and beat PowerShares to market by a couple days. We quickly raised $1 billion at the time at 83 basis points too, which is pretty significant. and ultimately ended up vanquishing INP later on. But then the market bottomed later that year, and really the story there was it effectively, in many ways, saved WisdomTree, because at the time it was our highest fee and also largest fund at the time. And a couple days difference, who knows? The story may have been very different, but it's a true story. So for the tenured ETF crowd here, that story will resonate on first mover advantage in the competition. It's sort of like a welcome to my life kind of story, right? For the novices in this room who haven't kind of been in the trenches there, this is kind of one tiny example of what you might be dealing with. So asset managers really need to recognize that ETFs are different. They require a change in approach, a higher tempo, we just talked about, different talent, which is important, and different ways of thinking. And I'm speaking again to multiple clients multiple times a week on these topics. And so let me give you a couple examples that we talk about when we engage with clients, especially when they're coming to market or trying to ramp up the volume on their ETF business. So obviously distribution is key. This is the most important, but surprisingly often receives some of the least amount of attention, at least up front. Decisions are often made from the top or from the side by product without necessarily a clear distribution plan. And I can assure you, if you build it, they will not automatically come. So we see resistance also from sales forces who feel they won't be able to get paid or just generally uncomfortable for whatever reason with the ETF structure. Marketing. It's hard to generalize here, but marketing ETFs, in my view and my experience, has always been a battle of the ticker symbols. But suffice to say that digital marketing is more prevalent in ETF sales. Lots of firms who have not adapted their marketing have really struggled, in my opinion. And when I talk to issuers, there's a clear divide between those who are locked in on the ETF effort versus those who live in fear of cannibalization. And a spoiler alert, if you don't do it, somebody else always will, and typically do so quickly. So data, obviously incredibly important. And again, in my experience, the ETF issuers have been advanced really in their use of data, or at least the ETF side of the house from an asset manager perspective has been more advanced than the traditional players, at least on how mutual funds are marketed. And those issuers who are buying data from the platforms or distribution intelligence from aggregators like BNY Mellon are doing so with increasing frequency and velocity and spending more there. So that's something that also we're involved in with our clients. A shameless plug. I'll skip that one, but you can talk to me afterwards. It's pretty interesting stuff. So I don't have time to get into it, but we look after our distribution intelligence platform that includes things like Pershing data, which is becoming incredibly valuable to our clients in terms of how to market, where to target, and how to look after those ETF opportunities, either for their products or against their competitors. Speed. I just gave you a story about speed. ETFs move fast. The product development cycle just happens at an accelerated pace. Not everything, like I just mentioned, is a race, like the race to market for the first India or X exposure. But even those launching actively managed strategies need to move quick. Other firms are just gobbling up those assets and honestly winning hearts and minds for those advisor and investor dollars. Capital markets, talk to many of you in this room about this function specifically, and it's often misunderstood. Mutual fund sales do not have to deal with the secondary market execution issues. I've seen many ETF sales go wrong at the point of sale. Capital markets plays a key role in that, but that role slowly evolves over time. And at the beginning, capital markets are really a bridge between the portfolio managers, the street, product development. But later on, it becomes more of a key extension of sales, helping clients really help them how to enter and exit the position in their ETF. You got to make sure they have a good experience on the way in and also on the way out. And when they Google it, which again, many advisors still do, they all Google, you want to be surprised at how many I talk to that really look on screen to see what the spreads are like and use that as sort of a quick benchmark, even again in 2023. But it's surprising to talk to industry professionals who still don't really have their head fully wrapped around what capital markets in an ETF context really does. So some lessons learned before we kind of move on to talk a little more about what's going on at the bank. I think, don't think too much. I think a lot of ETFs issuers who've been successful, I like to say get the buckets ready, or the product ready for when it rains, and get that mind share on a ticker or a theme. Don't do it on the cheap. We talked a little bit about what it takes. It's really hard to get your mojo back once you've lost it, but it does happen. And I already said if you simply build it, they won't come. And good ideas still wind up in the ETF graveyard. I have many attached to my name, but some also deserve a second act. But some really smart stuff just, for a variety of reasons, just doesn't get tracking, and sometimes it takes time, and sometimes there's a good reason for it. Don't fight the market, and if you do, it probably is going to take a while. And where do you find the first 100 million? If you can't answer that question, your odds of success are going to go down dramatically. And the answer to the other question, what ETF do I have to sell to buy your ETF? If you can't answer that, that's a problem. And block out all the naysayers. And I just saw, just to round this section out, I think MFS just filed. So they were the first mutual fund firm that launched a mutual fund back in 1924, have just filed to launch their first ETF. So this brings the largest holdout mutual fund manager in the US into the ETF market. So not just another one, but the oldest one that's out there. So how am I using ETFs to change the culture inside the bank? This was the hardest sort of section to think about, but I'll share some perspective on kind of what's going on behind the scenes, at least in my world. So BNY Mellon has been servicing ETFs for 3 decades, basically since ETFs have been around. But when I joined the bank, I immediately felt like I had, in some ways, parachuted behind enemy lines on sort of the wrong side of like the mutual fund ETF demilitarized zone. And I was an entrepreneur inside this large organization. So as I mentioned, gave you some stats before on the ETF side, stepping out, we're the world's largest custodian with more than 42 trillion in assets under custody. And suffice to say that ETFs have been a big growth story for the bank as the kind of these big shifts in the industry are putting money in motion. But this culture that I talked about earlier that is kind of built up around ETFs has been a catalyst for change inside the bank. And they usually have been happy to have me around, but they haven't always been fully comfortable with ETFs. Should it be set apart on its own? Should it be integrated with all the other registered funds with some of the ETF special sauce on top? I've wrestled and argued with this topic really over the last 3+ years, and the answer, in my view, lies somewhere in the middle. Leverage what you can, and that's common to multiple structures for scale and other economic reasons, to save costs, et cetera, but lean in hard to those special ETF requirements, and that's really exactly what we've done. And really some of those principles, I think, and again, extending to what I just talked about, what I think asset managers need to think about, we've tried to apply to the bank, but in a little bit of a different way. So, and I think many of these are really in parallel also to some of the guidance and thoughts we share with issuers on a daily basis. So establishing a microculture around ETFs. So I mentioned that sort of cadence around and the culture around us versus them, and trying to use that to your advantage. The ETF people often speak in an ETF dialect, and I think this remains important. At a minimum, it'll sidestep the risk of saying EFT in front of the wrong person, always a red flag. Really looked at creating and sort of repositioning an ETF sub-brand. In our case, we didn't start calling ourselves a different brand name, although that also works too, and it makes a lot of sense from a product standpoint often. But really it was about positioning the ETF business in a different way and using ETF as a catalyst to push the overall corporate messaging to be more market-driven, progressive. You kind of get the idea. Salesmanship, I think, was another piece of this. We convinced everybody that we're part of the solution, not the problem. And the industry is still in transition. And the majority believe that ETFs may be some part of the problem. So we've tried to, again, block out that noise and kind of make sure that that's how we're positioned inside the bank. We use innovation in ETFs to really push the boundaries of where we can go. So ETFs are making operating models better, faster, and cheaper inside BNY Mellon. I've seen this happen with my clients when they become issuers and start issuing more product, but it's also helping inside the bank as, again, we're leading the way from an innovation standpoint in terms of the technology that's needed, the speed, and the operating model that's used to support this business, which has a spillover effect on the rest of the bank. You need to think outside the box to get the best technology. Honestly, again, it depends. There's a wide spectrum in this room, but it's been very hard to get the enough really capital investment. It's grown over 3 times since I've joined the bank to keep pace with what's happening all around us. So let me give you a little bit of segue in terms of really what's next. I think the industry fee pressure has been pushing its way downstream. The industry is moving faster than the asset servicing and market structure can support that trend. And I think we're generally approaching a short-term natural limit, at least for the asset servicing business, in terms of where things are going to go. We're seeing fees hit bottom, and asset service providers, I think, will or may push back, not us, of course, especially on new products where legacy deals were in place and new entrants are still coming, which make it harder to compete on fees. So outlook. It's a little early to start with the 24 predictions, but I'll share a few observations from the inside. It's like putting up your Christmas lights too early. Shouldn't happen until after Thanksgiving, but I'll seize the moment, right? So some consolidation. The demand for targets in the ETF space still outweighs the supply. We continue to see multiple interested parties and clients looking to acquire ETF businesses. The bid-ask spread has narrowed somewhat, yet the valuation and the asking price by the sellers is still a bit larger than the bid at times. And the startups often want to get paid on what it might be than sometimes what it really is. And Rule 6c11 has killed the value of having a trust or exemptive relief. Cross-border activity, I think, will continue. Many clients are interested in moving eastbound and westbound across the Atlantic. We've already seen this a couple times this year. Samsung coming to the US via Amplify, ARK bought Rise in Europe recently. Many US issuers who have made the trip across the pond have really struggled, though, with distribution and product strategy. The same issues are preventing non-US sponsors from doing the reverse and coming here. The cash pile I mentioned earlier building up on the sidelines, to me, is a tremendous bullish signal for ETFs. So that $1 trillion plus, or 1.2 in the trailing 12 months that have gone into money markets is, again, a bullish signal. The only question is when and how much that money is going to come into ETFs. We've done well in every single market cycle, and again, this will be no exception. Product development, I think, will continue to run hot. In 2021 and 2022, our platform at BNY was launching 1 ETF a day on average. Cooled off earlier at the beginning of the year, and it's sped back up to about that level, and we're getting very close to that again. 57 ETFs launched in October, which was a record. The vast majority of that product is actively managed, and again, I expect that to continue. But there will also be more closures as subscale players will face more financial pressure, so I think the net number will be muted a bit. Mutual fund ETF conversions, a topic, again, I think it's going to come up later in more detail, but it's slowing down from our perspective. Fidelity just converted 6 funds to ETFs with close to $10 billion in assets, I think just a couple days ago. But the word is out. It's not easy. Conversions incur some cost, friction for the shareholder and the sponsor. We've handled multiple conversions so far, and sometimes they can be pretty hairy, which is why many of our clients are curious about what's going to happen with the ETF share class. And I think if the SEC approves it, there's no doubt it'll be a game changer. It also sidesteps the issues with retirement assets, as those qualified assets in the mutual fund class can coexist nicely with ETF shareholders. Qualified money and mutual fund ETF conversions are not a good match. So just to wrap up, really just a couple quick comments, and again, I really appreciate everyone's attention, especially at this time of year. It's a good moment to reflect. Have a wonderful wife, 2 gifted kids. We've been through quite a bit over the last few years, but I'm thankful. And I also want to express gratitude to my team and the bank and our partners who have given so much to help us grow and maintain a world-class business. So over Thanksgiving, my wife and I will be helping to take care of some family who needs us over the holidays, and I'm also the family chef, so I'll pretty much be in the kitchen. But again, thanks for listening, and I hope you found this as enjoyable as I did being up here, putting this together and speaking to all of you. So have a great rest of the day and the conference, and a happy Thanksgiving to everybody. Thanks.